It was a bit of a confusing week in the retailing business. In the debit column, another big private equity retail play bit the dust when the banks pulled the pin on the clothing and footwear outfit Colorado Group, just weeks after the big booksellers Borders and Angus and Robertson keeled over. On the credit side, retail sales were stronger than expected, and the listed electronics chain, HiFi, found itself so flush with cash it decided it would spend $170 million to buy back 10% of its shares, although it also reduced its profit guidance at the same time, hoping investors wouldn't notice. To find out what it all means, I spoke to the chairman of HiFi and private equity investor himself, Patrick Elliott. So, Patrick Elliott, is the party over for HiFi?
Well, I certainly hope not. Not expecting to. We've continued to have another record half year for the year ended. The half year ended 31st of December 2010, and we're looking for a record for the full year ended 30 June 2011. We're looking to continue to open 13, 15 stores a year for the next 3-5 years, which should see continued growth. So I think there's still plenty of good days to come.
Well, I asked because not only did you announce a reduction in your profit guidance during the week, but you also announced a big share buyback. And I wonder, does that indicate that you see a lack of growth options for spending money?
Well, one of the things that we mentioned to our shareholders at our annual general meeting probably about 2 years ago was that we were moving from an investment phase where we were a net investor of cash to being a net generator of cash. And throughout that massively quick build-up period, early since the IPO, we generated a lot of franking credits. This was an opportunity for us to have an appropriate level of gearing on our balance sheet, distribute some cash and some franking credits back to our shareholders.
Of course, the other thing that happened during the week is that you announced a big write-down of your investment in the Clive Anthony stores. I wonder if you can tell us whether that means that you really see no future for Clive Anthony, particularly with the way that Woolworths is now going into big box appliance and hardware retailing.
Well, I think the Clive Anthony experiment hasn't succeeded in its current format. We're looking at various options in terms of how we deal with that, but we do know that doing the same as we have done over the last 4 or 5 years isn't going to generate an adequate return on our invested capital. So we do need to do something different.
Well, does that something different for Clive Anthony include closing it down?
Well, that's certainly one of the options that we're considering. I think the expectation is we'll be able to convert quite a few of those stores to HiFi stores. We're looking at perhaps a change to the format for those stores, but remaining in appliance retailing, although it may be on a somewhat smaller scale. And some of those locations which aren't profitable, we will look to close.
Well, obviously all retailers are finding it pretty challenging at the moment, especially the ones that are owned by private equity funds. And I'm thinking here, of course, of Colorado, which went broke during the week. It's owned by a private equity fund. But do you think we can now conclude that the enthusiasm that private equity funds had for retailers a few years ago was actually a disastrous miscalculation?
Well, I think there's probably no doubt there was an over-exuberance by the industry in its foray into retail over the last 5 or 6 years. And I think one of the things that everyone needs to recognise within retail is that you are naturally, you have a leveraged position by virtue of all your property leases. And so to add financial leverage across operating leverage increases the risk profile of those businesses significantly. It works very well while the economy continues to boom and consumer spend is there. But as that starts to fall away, it clearly creates a lot more pressure on any business. So look, I think we'll certainly see more mishaps within private equity-backed retailers. But that's not to say that private equity doesn't have a role to play there, and JB was a private equity-backed business. It was able to raise development capital at a very important part of its life to be able to really expand outside of Victoria and be the company it is today.
Well, I guess the point is that the operational leverage through the leases makes retailing unsuitable for a high leverage funding model.
Look, I'd agree with that. I think if you compare it to another industry which doesn't have the same level of operating leverage through all those leases, it certainly shouldn't carry anywhere near the same amount of debt. And I think what happened during the period of perhaps lesser financial criteria around lending, we were finding quite a significant amount of leverage still being placed over the top of those retail business, and it clearly wasn't sustainable in a down market. And unfortunately, that's a lesson that's been learned the hard way for a number of people over the last couple of years.
The other problem for retailers, apart from flat consumer spending, is online retailing, which seems to be taking off. And I'll note a couple of things about JB. Firstly, your prices in your online store are about the same, or exactly the same, in fact, as those in your physical store. which suggests that it shows that you're not discounting through the online store. And secondly, you're building physical stores, as you said before, at a rapid rate. So what does that say about your view about online retailing?
Well, there's been a lot of talk about online retailing since the late 90s, and I remember, quite clearly over 10 years ago, discussions around whether JB would be successful with the advent of online retailing, and it was clicks versus bricks. Now, that hasn't changed. I mean, what has changed, I think, more fundamentally, has been that the Australian dollar has now risen over parity with the US dollar, and it's likely to stay here for some time. And what that has done is it really has opened up the opportunity for parallel importing. The internet model is particularly well suited to do that, whereas the bricks and mortar model is less so. So this discussion is very much more around where we are with currency perhaps than any significant change in technology or the uptake of technology. For us at JB, we do have an online business. It's still relatively small. It represents for us probably 2 or so good stores, but we do see that it is growing and growing quite quickly, and we certainly want to support that growth. I think the other part which we absolutely recognise is that our bricks and mortar model is a very low cost model. Our cost of doing business, which is everything below the gross margin line, is about 14.5% of sales. There wouldn't be too many online retailers who have that low cost base, and so we're comfortable that with our scale, our buying power and our low cost of business that we can compete quite effectively with an online retailer, and to that extent clearly pushing our own online model.
But is what you're saying that because the dollar is where it is, there's no point really trying to compete with international retailers flogging stuff into Australia through the internet, and you might as well just concentrate on stores, physical stores?
There's no question that with the dollar where it is and without it likely to change in the short term, the opportunity to see direct imports into Australia into the categories in which we retail is more significant than it has ever been. Now, that is less likely to happen in certain categories such as wide panel TVs, is more likely to happen around some of the smaller categories, around some of the software items and potentially cameras. But what actually happens, and maybe it's a lag effect, but what we do find is that we buy from local suppliers. The suppliers recognise what's happening with international pricing and will ultimately adjust domestic pricing to be able to cut off, if you like, that parallel import. So I think what we're experiencing is a bit of a lag effect. We've seen a very strong rise and a quick rise in the Australian dollar. Eventually you'll see those local suppliers catch up on local pricing. But that leads to another issue for all retailers here, and that has been price deflation. We saw it very quickly in a couple of our categories, but I suspect it's likely to remain an issue to be managed by the industry for a few years to come.
Thanks for joining us, Patrick Elliott.
My pleasure, Alan.